What's up, everybody? It's David. We're going to be looking at a little bit older video today of Patrick Bet-David, my mentor Tom Ferry, and David Childress, where they had a discussion back at the end of last year about some predictions on the housing market, what's going to happen in the U.S. housing market this year. Patrick Bet-David thinks the market's going to crash. He's going to talk about that. We're going to break that down. We're going to listen to what Tom and David have to say about the U.S. housing market, and I'm going to give some of my opinions on what's happening today in the Portland real estate market.
And I have very limited perspective on this, having gone through a few recessions, sort of being birthed, Patrick, professionally in 1988, buying my first house in 1989 at 19 years old, just in time for the entire real estate world to collapse from the stock market bust of, 1987, 88. Having gone through this enough times, I just want to remind the listener that, you can doom and gloom, or you can recognize that all we're really doing is taking a whole bunch of people that are in our space, real estate, who were just sort of riding a big, massive wave and thought they were a really big wave surfer, and those people are going away, right? This is a professionals environment. This is an experts environment. So regardless of what happens to, recession, which, Patrick, I thought we were already in back in summertime.
Yeah.
And everyone forgot about the recession we were in when the pandemic started. We went straight into a recession, right, overnight. But let's talk about for my audience.
So let's break that down real quick. People think because there's a quote unquote recession, home values have to decline. When we look at history, that just isn't true. I believe it's in 4 of 6 of the last recessions we've actually seen home price appreciation. By classic definition of a recession, we had one in Q2 and Q3 of last year. What happens after a recession? Usually what you see are mortgage rates decline. We saw that. Now mortgage rates are coming back up. But there's all this talk of this looming recession in the US. I mean, it's been going on for over a year. We really classically had one. We're still talking about, are we going to have one? Are we not? We're just in a weird time because of COVID.
I think what they're really concerned about is what's going to happen with home values. So you put out some content 3-4 months ago and you were like, hey, this is like 2006 and we're going into 7, 8, 9, 10. Right. And, David and I have been doing this show, How's the Market, for a long time, This Week in Housing. And we've got some different data points. So it's going to be interesting to sort of not debate, but just I want to hear your perspective, David's perspective, and we'll let our smart listeners decide which they believe is correct. So Patrick,
Sure.
Prediction on house values. Talk to us.
I think it's going down. And I think if you don't believe it's going to happen, you're either in the industry or you're reading a little bit too much of Norman Vincent Peale, Power of Positive Thinking.
So I want to address that real quick because I am in the industry. For years, I've been selling real estate since, well, really for 15 years. And I would look for reasons why value should decline. And you could find a lot of reasons you think values would decline. But if we look at the history of the Portland market, as far back as I can get reliable data is 1992. And since 1992, there's only been 4 years where values have declined. So history actually shows us that what goes up must come down. We hear that's not true when it comes to housing. We'll probably talk about that more as we keep going through the video. I am in the industry. If I thought values were going to come down, I think I would probably be one of the first people to say it with how deep I get into the data all the time. But when we look at the history of the Portland market, we basically can refute the statement that David just made.
Or you're overly confident, or, you want to keep everybody calm and not panicking, not any of that stuff. Now, I want to say a couple of things here based on what you said and what David said. Number one, short-term thinkers are the ones that's going to get destroyed in the first place. But that applies to every industry.
100%.
Insurance, stocks, real estate, commercial, pick it. It doesn't matter. If you're a short-term thinker, you're going to get destroyed. You should have never gone in real estate the first place, because you just have to know every 5 to 10 years, real estate's going to take a hit. The reason why I didn't do real estate and I chose insurance was a complete different reason. Here's why. In real estate, when the economy, like every 5 to 10 years, when a market correction does take place, it's dramatic for the average person in real estate.
Yep.
In the insurance side, when a major market correction takes place, annuities blow up.
So let's look at that real quick. There's a lot of alarming statistics based on the National Association of Realtors data. It's something like 80 to 87% of agents fail out in their first year. And it's something like 90% of agents cycle out of the business every 5 years. So that might be true what David's saying a little bit, these 5 to 10 year cycles, housing takes a hit. The real estate industry is really hard. Going back to what Tom was saying about we're going into an experts market, sales volume, meaning the number of homes sell, tend to fluctuate. If we look at home values in Portland, they don't. But when the number of homes selling fluctuates, that's when you see lots of agents exit the industry because they just weren't skilled at building a business. They weren't skilled at building a clientele. I know David's alluding to home values go up and down every 10 years. The data we have for the Portland housing market completely refutes that. And we'll put that on the screen right now.
Like right now, I can't even tell you how much annuities we're doing. And when I tell you annuities are being sold by guys that are not necessarily the best annuity salespeople today. We're up 100% for annuities year over year, and life isn't up 100%. So I can't say, well, let me tell you, we're up life, and we're not up life 100%. We're definitely not up life, but we're up annuities 100% because people are worried. So that segment of the market is sitting there saying, I got $400,000. Do I want to put it into another, equities account, or do I want to put in something that's going to give me income with a bottom guaranteed, et cetera, et cetera? I'm protected. They're interested in annuities, and almost clients are selling themselves. We're not selling them on their annuities. They're just coming to us. So that's the insurance space. On the real estate side, how many years in a row did realtors and loan officers win? Let's process that. How many years in a row? 10, 12 years?
10
straight years. Now, Tom, you said you got into this in the mid 80s, right? Where you're not.
And I would just say, how many years in a row have homeowners won? If you're a homeowner, on average, based on our average rate of appreciation over 30 years in Portland, if you own a house for 12 and a half years, your home price has doubled. That's been the average over 30 years. I don't think it has as much to do with the industry professionals winning. This is a hard business. Even in good marketplaces, agents fail out. But homeowners win. The US government says the average net worth of a homeowner is 40 times greater than that of a renter. So it's not about realtors or mortgage brokers winning or losing. It's the client, the customer that we're dealing with who owns real estate. They're the real winners.
Not mid 80s, late 80s.
Late 80s.
88, you said. 88 or I think said 88.
89, bought my first house and started in the industry.
Perfect. So I don't think you can say since 89, there's been a time where the market's done as well as it's done 10 years straight. So when it does well 10 years straight, it's not because realtors are great. It's not because a lot of loan officers are great. They're delusional. 80% of them are delusional. And a time like this is going to expose them.
That's true. Lots of realtors are delusional. But again, it's not about agents being great or mortgage brokers being great. It's about real estate being a great investment.
Now, let me give you an idea why I think next year it's going to be a challenge for real estate. And let's debate this and let's have a good time. So I'm looking forward to it. Here's my my prediction. I just bought a Tiger Woods' best rookie card today. Last night, I made the offer. I'm sending the money today, wiring it over. I bought the best card today. So it's a nice card. I've been wanting this card for a while. And the same card 11 months ago sold for $396,000. I bought it for $140,000.
Yep.
That's a pretty nice come up on the $140,000. Okay. A Michael Jordan rookie card, PSA 10, a year ago, 14 months ago, sold for $690,000. Yep. You can buy them right now for $140,000, $150,000. If you're patient, you'll find them at $140,000, $150,000. The Luka Doncic card that sold on his birthday a year and a half ago for $5.2 million, just sold for $3.2 million last week. Okay.
So we can't compare trading cards or Pokemon or things like that to housing. And what we're talking about like a house trading as a playing card. Of course, the value of that can go up and down because there's not as much economic utility to something like that as, let's say, a home, right? Like Adrian on the other side of the camera, he's renting a house right now, which I'm sure he'd much prefer to own real estate. And people that own homes, they fiercely protect their equity. I mean, they fiercely protect it. Generally, the average consumer we're working with, they're not paying $400 or $400,000 for a playing card and then have the ability to trade it later for $150,000. So I'm not sure where David's going with the storytelling here, making the comparison against housing, but I would just, challenge anyone watching that who agrees with that to think about the economic utility of a home versus the economic utility of a trading card.
Okay, that's a 40% drop off. You saw Bitcoin go from 68, 69 to what is it today? 15K? Yesterday, 16K. We can look it up. It's changing. An FTX scandal and how the folks at Binance are furious over this Sam guy. A bunch of crypto people are upset over him. Okay, NFTs, 94% activity is gone, right?
So since the time this video came out, the crypto market, the NFT market has really started to deteriorate because again, it didn't have the best economic utility. It was, based on Adrian buying a Bitcoin, selling it to me at a higher price, me selling it back to him, etc. Real estate has a different economic utility.
Jewelry, watches, Patek Philippe watch, or Rolex watches, or Hublot watches. People were buying them left and right. And hey, I bought this for 60 grand. People want to pay me 110 for it. Damn, a year ago. Sell it, sell it, sell it. Great. This thing's going to go to 300. That thing's coming back down to 60. Luxury watch market is a completely different market. So who buys?
But Patrick, I can add in there boats, airplanes, cars.
Yeah.
But we don't live in any of those.
But I want to tell you this. So let me do this and then push back on what I'm saying with this. So watch what I'm saying here. This is where I'm going with this. So to me, which comes first? The drop of home value or shit that we buy that we normally would have never bought? To me, first this goes down, then this goes down. Because we're living in reality is this, what you're talking about, Pat. We're not living in those things. Both, I just got off a call right now.
So the reality is there's this popular quote that what goes up must go down, but that's just not true. If we think about lots of things that you experience every day, the price goes up. And there are some things where pricing fluctuates, but not everything that goes up comes down in price. And yeah, it makes sense that, if I bought this shirt and they didn't make very many, and then someone else wanted it, maybe I could sell it to that particular person for more money if they were flush with capital. But also, it stands to reason that someone would only pay me less than what I bought this shirt for.
Now, right before my call with you, I had a call. They're trying to sell me these 3 planes. And the people that are selling me these 3 planes, oh, this guy's very motivated. I said, of course they're motivated. Everybody's motivated to sell jets right now. And everybody's motivated to sell yachts right now. I live in Fort Lauderdale, the yacht capital of the world. Every day I'm getting a call from my broker saying, hey, this $13 million yacht, you can get it for $4.8 million. The buyer, the seller's very motivated. Yes, I understand why he's motivated. He owned 5 yachts last year. He's trying to downsize to 1. Why do you own 5 yachts? So that comes first. And then a data point that concerns me temporarily. Nothing concerns me long-term, Tom and David. This is what the audience has to realize. There isn't anything long-term that concerns me about real estate, mortgages, insurance. Nothing concerns me long-term, but short-term, it does. And as a paranoid guy, this is the part. So January 1st, we have roughly, as a nation, $2.3 trillion in cash. So collectively, we're trillionaires, okay? Beginning of the year, we have $2.3 trillion. Do you know Q2 and Q3, we have lost that $2.3 trillion by $300 billion each quarter. So we went from 2.3 to 2 trillion to 1.7 trillion to today we're at $1.6 trillion that we're sitting on. Okay. That's like somebody going from $23,000 in a bank down to $16,000. It's a little concerning. It's about a third of your money that's disappeared. Husband and wife are sitting there saying, babe, we're not broke yet, but babe, in about 6 months, if we don't do something, maybe you need to drive Uber on the side and not tell anybody about it, but we got to figure something out here. So if the savings starts depleting, panic goes up, the guy who sold me the Tiger Woods card should have never sold it. I told him when I bought it from him, I'm telling you, don't sell it. Sit on it for 2 years. He says, I need the cash. I said, then I'm only paying you 140. And he said, yes, he should have never sold it to me, but he needs 140 today. So I win in this situation because I have the cash, right? So all I'm saying to you is I think it's been going a little too long. People's spending habits is concerning me a little bit. Our savings is going down. All these people that were sitting on all this cash because we kept sending free money to people, unemployment's going up. It's going to go really up in the first quarter and second quarter. If that goes up, crime goes up. I don't know. I'm just not too confident about 2023.
All right. So Patrick, lots of examples. I know you'll appreciate this. In 2006, every seminar I did, and I didn't get on YouTube until 2007, super early. But out in 2006, I did have a audio podcast before we called it an audio podcast, about to sign a deal with BlackBerry to put out all this content. But at the end of the day, here was my message: sell everything, get cash, the entire world's going to fall apart. That was in 2006, right? By 2007, I was getting my clients REO accounts, helping them navigate the market, helping them get rid of leases.
An REO account basically is an agent would be listing properties for sale for banks. If you look in the Portland housing market right now, there are basically no bank-owned properties. Are there distressed homes that are outdated and there are some people suffering from not being able to pay their mortgage because of unemployment? Sure, that exists in every single marketplace, but we are a far way away from a foreclosure crisis. I think actually nationally, we have the lowest number of foreclosures we've ever had in the history of the US housing market.
Helping them recognize that the houses they were buying in Las Vegas with 1% down, 3% down, that were going up in appreciation every single day, sell them as fast as you can. And a lot of people listened. So I may be a super fan of the industry. And yeah, it's super important to me, but make no bones. In 2006, it was obvious. It's just not as obvious today based on the data we're looking at. David, talk to us. What's prediction on house values? And by the way, I'm going to say this. Home prices are going down, Patrick, in some markets. And in other markets, they continue to climb up. So it's going to be a market by market thing. There could be somebody right now in Dubai listening to this. There could be somebody in Berlin listening to this.
So if we actually look at the Portland housing market, we had a 6.8% rate of appreciation in 2022. And over the last 12 months, we've seen a 5.4% rate of appreciation. So the rate of appreciation has been slowing down, but not at an overly concerning level.
People in Australia listening to this. There's absolutely people listening all over the US and Canada. Every market is different, but we see the national numbers and then we got to look at the local numbers. But David, fire away.
Sure. So I think the housing market piece is where it gets interesting in this market. So let's talk about that kind of benchmark this year, what folks are saying for next year. This year, generally when people talk about house values, they talk about it on an annual basis. Now, in a market like this, they start to talk about it on a monthly basis, but that's not, you don't go to your neighbor and say, how much did your home appreciate or depreciate last month? But in a fast moving market, that becomes the topic. So this year, if you look at nationwide home prices, they will appreciate somewhere between 8 and 10% this year. No doubt that's cooled off. No doubt we've seen month over month depreciation. I'll get into that in a second. What do we see going into next year? We see a market that's flatter. I certainly don't see a market that crashes in values and not a market that's anywhere remotely near what we've seen over the last few years. I would say that's an anomaly market, an unhealthy market, if we're honest about it in our business, but something that, that nationally looks like, a percent appreciation or a percent depreciation in that ballpark. Now, here's what's interesting. You brought up a point, Patrick, about folks losing their job and sales, having to ultimately sell their home. I think that's the direction of that topic. Well, we're not seeing a market right now where there are forced sales. And you could say, okay, we're going to move into a market where there are forced sales. But right now, in this country, the average homeowner has over $300,000 in equity in their home. The difference between today and 2008 and the housing crisis is, when people went to do something with their home, they didn't have any options. And so they were foreclosed on, they had a short sale, a distress sale, whatever it is, and they lost money. If you remember back then, if you owned real estate and you had to sell it, the topic was, how much are you going to lose? And the topic today is going to be, you may not make as much. That's the biggest difference in the market today versus the housing crash of 2008.
One of the things we have too is we have a lot healthier mortgages. After the mortgage crisis, after the Great Recession, there were a lot of changes that happened in the ability for people to qualify for a mortgage. So the state of the mortgage market is just much healthier. If we go back to what I said earlier, we have one of the lowest rates of foreclosure in the history of the United States. And a lot of that has to do with the quality of the borrowers that actually own homes today.
And so when you start to take a look at that, nobody's going to walk away from $300,000 in equity in their home. And there's this term they use, it's called downside sticky in products or specifically in housing. If there's not a forced sale, then you're not going to see a depreciation in values. What do we know for the last 4 months in this country too? Fewer homes have been put on the market because 92% of those with a mortgage have a mortgage less than 5%.
Yeah, so let's look at that real quick. When he said if there's not a for sale, people generally don't sell their home for less. It's very rare that we actually work with a homeowner that has to sell. In most scenarios where we're working with buyers and sellers in the Portland market, it's something that they want to do. It's very rare that we have a homeowner that calls us and says we have to sell by this date. And because so many people have such a large amount of equity, renting their house out becomes an option for many people. If we look at what's happening today with new listings coming to the market, the perception a sale might be difficult is actually caused a 31-year low in new listings. People are just choosing not even to try. So even though we have less demand in the housing market from buyers, the supply is lowered to meet that demand, which is keeping housing price appreciation going.
They're good. You literally can't go out and rent something for which you can buy a home or what their mortgage may be. So I don't see a case being made for a massive decline in home values across the country because the data, Tom, and Patrick, just doesn't support it.
Yeah, and again, I'm going to make the argument, literally on a coaching session this morning with one of the number one teams in all of the Phoenix Metro, and we're talking about how Invitation Homes and all these companies have bought, whether it's 10 to 15% of the market, and they were buying mainly guys in the outside, the outlier markets where they were getting incredible rents and fast appreciation. And there's no doubt, if 3 homes sell at a lower price, the new comp is set. And we're already seeing a phrase I haven't heard in a while. Tapes. I was on, hey, could you give us a look on pricing of these 45 houses? So I think we're going to see it, but Patrick, I think it's going to be, again, market by market. And David, it's going to be some of these outlier marketplaces. Sure, and then don't even get me started on New York City, which never got good during the pandemic.
All right, so let's just summarize what we saw here as compared to the Portland housing market. There's a debate going on about are home values going to go down based on an opinion, or are things going to stay stable based on statistics? The way that we like to advise our clients is completely statistically. There are price point segments in certain cities in Portland that have not done as well as others. There are certain price points where we've seen moderate depreciation or moderate appreciation, and there have been some marketplaces where we've seen 10% plus appreciation because the market is segmented. So if you've been looking to buy real estate or sell real estate in the Portland metro area and you want to know what's really going on, you don't just want some other agent's opinion or your Uncle Jeff's opinion who's never owned a home, you can reach out to us at hello@hillshirerealtygroup.com. If you want to see more videos like this, if you want to hear more analysis on the national housing market as it compares to Portland, on just the Portland housing market, the suburban cities that we work, make sure to like and subscribe to our channel, and we'll see you next time.